one additional concept we are going to discuss, which is intragroup sale of assets. So intragroup sale of assets. When I say here assets, generally we means PPE, okay? Property, plant, and equipment. If you remember, we discussed before intragroup sale of inventory, and from intragroup sale of inventory, we had that concept of unrealized profit, provision for unrealized profit. So we calculated how much was unrealized profit, and we subtracted it from the group profits, and we said debit retained earnings and credit the group inventory. So this situation is also quite similar to that thing. I mean, the logic will apply the same. The difference is that inventory transaction you will see very frequently. Almost every consolidation question will have intragroup sale of inventory. Intragroup sale of assets might not be very frequent, but it may come in. And it does have one difference, because inventory we do not depreciate, but assets we make depreciation. So that is one additional, how to say, adjustment for depreciation which you need to make. So we'll create some short example. Let's suppose that there is a parent and there is a subsidiary. Parent in its book, they have an asset for, let's keep a short number, $8,000. They sell this asset, and I'm talking about a non-current asset which is being depreciated. They sell it to the subsidiary for $10,000. Generally, assets are not frequently sold out. If subsidiary has purchased this asset, it means that they intend to use it, okay? Inventory they purchase and they sell, but non-current assets, usually they remain within the business. They are going to use it for some time. So what parent they did, actually parent, it made $2,000 profit. If you pay attention, the book value of the asset was $8,000 and it was sold for $10,000. So there is a $2,000 and you can call it unrealized profit, because this is the profit which is between the group entities, okay? In their individual financial statements, that is fine, because parent will record this gain on disposal of 2,000 and parent will show gain on disposal of 2,000, because parent will say debit cash. Let's suppose they got cash, 10,000. And they would say credit the non-current asset, which was 8,000, and the parent will, the individual company will record credit gain on disposal of 2,000. For individual, that is okay. Subsidiary will also say that I purchased an asset, and they would say debit non-current asset 10K and credit cash 10K. So as far as individual financial statements are concerned, we see no problem. That makes sense. But when you are going to make the group financial statements, you need to make adjustment for that, because we say that anything which is within the group entities, we call them intra-group transactions, they must be eliminated. And besides, the assets should be recorded at the cost to the group. So what is happening now? There are 2-3 things which are making problem. Number one, the parent is recording a profit or a gain of 2,000. Parent is recording a gain in 2,000 here, which is not allowed under consolidation. Subsidiary is recording the asset at $10,000 because they purchased for 10,000, but the cost of the group was 8,000. This is also not allowed. So we need to actually, so there's a $2,000 unrealized profit. If you go back to your logic for inventory, then what you should do, you should say debit group retained earning. If it had been inventory, 2,000, and credit, non-current assets, 2,000. This could have been like this, okay? My profits are overstated by 2,000, so I decrease the profits. My assets are overstated by 2,000, I decrease my assets by crediting them. That actually logic it fits in. But there's another problem as well. That problem is depreciation. What are you going to how are you going to handle the depreciation? Because what happened? What happened that let's suppose that this asset depreciation was 25% before in the parent books, and it is still 25% in the subsidiary book, because there is some group policy, let's suppose. So actually what happened that parent, if it was in parent, so if we record the asset at cost to the group, we should have multiplied 8,000 with 25%. So depreciation should have been 2,000. But because subsidiary recorded the asset at 10,000 and subsidiary is taking 25% of 10,000, so subsidiary is taking a depreciation of 2,500. This is the issue. That's depreciation of this asset should have been 2,000. But because of that overstatement in value, the subsidiary charged this depreciation of 2,500. So it means what now? This means that parent actually overstated the profit by $2,000. By when it sold it, they recorded 2,000. So in parent's book, 2,000 profit was overstated. Subsidiary is charging $500 depreciation more. You should have been charging 2,000, but you are charging 2,500. So it means that subsidiary is recording profit 500 less, because when you are charging more, depreciation profit is less. So overall to the group adjustment, this becomes 1,500. So what happens that for the group profit, it is 1,500. The difference in the group profit is 1,500. So what we should be doing, debit group retained earning 1,500. This is what we should do. And now when we will make credit to non-current asset or credit to PPE, now remember that this asset which you purchased actually for 2,000, for 10,000, you purchased it for 10,000. And after subtracting 1 year, because there was a total, okay, let's make it very simple. Let me not make it, I'll come back to this difficult style in a way. Initially, there was $2,000 difference. When this transaction happened, the asset was overstated by 2,000. But out of this 2,000, this depreciation additional, so this was additional, and the additional depreciation is 500. So it has been depreciated by 500. So it means that the net amount or the net balance, which the adjustment we need to make in the asset is also 1,500. What we should have done, 1,500. So debit group retained earning 1,500, credit non-current asset 1,500. Let me show you this 2,000 thing in another way. Let's suppose that parent, if let's suppose that in the absence of this intra-group transaction, parent had it for 8,000, parent would have charged depreciation of 2,000, like 25%. So it means that this asset should have a net book value of 6,000. But when it was transferred to the subsidiary took it for 10,000, and subsidiary is taking 25% of 10,000, which makes it 2,500. So in the subsidiary book, the asset is now 67,500. This is the same number, 1,500 adjustment, which means that asset should have been recorded at 6,000, but it appears at 7,500. So we need to bring down the value of asset by 1,500, which is like this. Now you do it like this way. This is little longer. This is little longer. What you need to remember, if you want to do it in an easier and quick way, you should see that how much is the profit charged and how much is the extra depreciation. And the difference of these two, you can calculate very quickly. For example, my asset was 100K and I sold assets for 150K. So 50K was unrealized profit. Now, how much is the difference in the old depreciation and the new depreciation, the extra depreciation? You subtract that and you get to the number. With that number, you should say that debit group retained earning and credit non-current asset. So when you make this adjustment now, what you are doing now, so this particular one transaction will require us to make adjustments like this. Let me just clear, some part. So what type of adjustments we are making? We are group retained earning. We are decreasing by 1,500. Group PPE or non-current assets, we are decreasing by 1,500. How do we do that? In many cases, you will see that parent, they will tell you that parent has assets of, let's suppose, 100,000. Subsidiary has assets of 50,000. And when you will make for the group, you will say 100,000 plus subsidiary 50,000 minus this 2,000, which is the unrealized profit, plus this 500, which is your extra depreciation. When I say minus 2,000 and plus 500, so I'm actually, in reality, I'm subtracting 1,500. So group PPE should decrease by 1,500. Group retained earnings will go down, group PPE will go down, and the number will be 1,500. Does that make sense? If there is any question, you guys can ask. Joseph, Rajesh, Janesh, Ronnie, any question? Hafiz?
No question.
It's clear, right?
Yes.
Okay. Now, there is one more thing. I'll just discuss it here. That is about intra-group dividends and interest. Intra-group interests and dividends. This is also a common transaction. Sometimes the parent gives out loan to the subsidiary. Sometimes the subsidiary gives loan to the parent. In such a case, what will happen? That the two statement of financial positions you will have, the parent and the subsidiary. So let's suppose that parent is giving, okay? Let's suppose parent is giving. So parent will have here loan receivable, and let's suppose the loan is 1 million, and the subsidiary will have in its liability loans payable, and they will write down also 1 million. So you need to cancel out these two things. Loan receivables and loan payables on the balance sheet will be cancelled out. But then this loan of 1 million was given at 5% interest rate. At 5% interest rate, which means that subsidiary probably has given it out to the parent, the interest. And that interest is also shown as you have two income statements. So let's suppose if I talk about the income statement, for parent, there would be a finance income. And for the subsidiary, there would be a finance cost. So 1 million into 5%, which means 50K. Parent was showing as finance income, and subsidiary was showing 50K as finance cost. Parent might have other finance income as well. Let's suppose that parent finance income probably is 80,000 because it has finance income from other sources as well. So you need to see that with respect to this loan, how much of the finance income lies in between. So we know that out of 80, 50 finance income is related to the intra-group loan. So that should be subtracted. So when you will make them, you will take 30,000, like 80 minus. So this will be cancelled out. This will be cancelled out. And the finance income would remain 80 minus 50, 30, which is from outside the group. That will be shown. So finance income and finance cost will cancel out each other. Loan receivables, loan payables will cancel out each other. And a very similar transaction is intra-group dividends. Intra-group dividends. These also must be subtracted. We subtract intra-group dividends as well, because like we say that the concept is anything which is within the group should be removed. So we remove intra-group assets, intra-group loan receivable, intra-group loan payable, intra-group finance income, intra-group finance cost, and of course intra-group dividends. So these all should be subtracted, not in the individual. I'm not touching the individual financial statements. What P will make, they will make. What S makes, they make. I don't have any problem with that. We're only making adjustments at the group level. Any question?